One of the most important books I've ever read as an investor was Phil Anderson's The Secret Life of Real Estate and Banking. Now, in the book, Phil goes through over 250 years worth of history on the booms and busts of the American property market. And what he finds is absolutely insane. Now, Phil got the idea for his work by the great Fred Harrison, a UK economist that looked at over 350 years worth of booms and busts in the UK market in his amazing book, The Power in the Land. Now, what both Phil and Fred found is there's about an 18.6 year real estate cycle that starts off the bottom of the last GFC and works its way all the way to the next GFC. Now, while Phil's work is extremely complex, the concept and the idea is super simple. And that is, economies work on cycles over a series of time with very, very specific things that happen during that time that you can not only use to trade the cycles better, but invest better and invest with more safety and more confidence. Now, if we look at the start of the current cycle, it began back in about 2012, once the GFC was slowly starting to pass. Now, what happened after we moved through a GFC or a really bad financial event is that the economies around the world are still in recovery mode. People are still very, very fearful for most of the first half of the cycle, and the governments as well as the banks around the world want to get the show back on the road. Now, overlaying Phil's analysis of the long-term cycle with the Australian market and the data that I've been able to access from Homely as well as CoreLogic, house prices in Sydney and Melbourne in the first half of the cycle are the first to recover and often do as much as 100% growth in that first 7 to 8 year period. What normally happens during this period where prices in Sydney and Melbourne go nuts and certain stock markets around the world start to recover is the governments and the banks artificially and overstimulate the economy to the point where everybody starts freaking out and we get to the mid-cycle slowdown point. Now, the mid-cycle slowdown was COVID, but previous mid-cycle slowdowns have included things like the dot-com crash and the recession that we had to have. Now, when we hit the mid-cycle slowdown point based on 13 of the last 18 and a half year cycles, we generally get a significant event that nobody expects, which completely rattles the market and creates intense fear. Now, during that time, property prices globally generally decline by between 0 to 10%, sometimes as much as up to 15%, and stocks generally decline by between 30 and 50%. Now, this event generally scares the absolute shit out of people, especially those with a strong living memory of the last crash, and creates a bit of a period of panic, of off-selling and fear in the market like we've been going through for the last year and a half. Now, what normally happens in the mid-cycle point is governments start investing in infrastructure, banks start lending more money, and we get to a point where people realize it's not as bad as the last GFC. There's a lot of cash in the bank, there's a lot of money still on the sidelines, and asset prices over the full cycle are still relatively affordable in many markets around the world. Now, once we move through the mid-cycle slowdown point, we begin to see asset prices in the secondary markets really start to move up in value. And again, when I overlay the Homely stuff and the CoreLogic stuff, markets like Brisbane, Perth, and sometimes Adelaide have done as much as 100% in the second half of a real estate cycle. Now, generally what we see in the late second half of a real estate cycle is what we call the winner's curse. And that is where people have obviously not been making money in stocks or property for a period of time, and they start to finally work, and people get to a point where they're like, I've been sitting on the sideline either from the mid-cycle slowdown or the last GFC for so long, and things finally look good that I'm just going to rush into the market. And that's where you see gold prices potentially, stock prices, some commodity prices, and house prices in many markets around the world absolutely blow up at the same time. Now, what happens at this point is absolute exuberance. This is where you see the tallest buildings in the world open up. This is where you see the people in the most leverage, the most debt, the most beautiful hotels, the most incredible cars. It's when you see everyone and all the influencers on Instagram and stuff in the future absolutely living it up. You'll see heaps of people in real estate, all of the get-rich-quick people coming into the stock market at that time. Now, this is probably the most dangerous part of the entire cycle, because if you buy just at the end when everything's blowing up, then as we move into the next financial crisis, you can really come undone. Now, as we move through the winner's curse phase and then into the next recession, this is when things can go really bad. This is when you see people all over the world completely over leveraged. And this is what that movie, The Big Short, was all about, the winner's curse into the next financial crisis phase of the cycle. Now, what we normally see as we move into the next GFC is property prices in Australia declining by between 10 and 15%. In the US, it gets a lot worse, where we normally see prices in almost all of the markets decline by as much as 15 to 40%. And if we look at stock markets around the world, they get absolutely smashed by as much as a 40 to even 60% decrease in the average stock price. This particular window can represent one of the most incredible buying opportunities. And as investors, we may get one or two if we're young enough in our lifetimes. Now, last time we went through this particular stage, houses in Noosa were selling for $3 million at the top of the winner's curse before the GFC, were selling for as much as $600,000. Now, if we look at a full cycle on Noosa property from 600K here through to where prices are now, some of these same properties are selling for as much as $5 million on the river on Noosa. Now, reading Phil's book and understanding this stuff deeply and catching up with Phil over email, on the phone, and for many, many lunches now has completely changed my ideas and the way that I invest as an investor. For those of you who haven't already done so, I highly recommend going out there and reading Phil's book, The Secret Life of Real Estate and Banking. And if you geek out on the data as much as I do, then definitely check out Fred Harrison's Boom and Bust and The Power in the Land. While there is no crystal bullet or perfect way to invest, because sometimes these cycles go short and sometimes they go long based on history, I think understanding when are strategic buying points during the cycle to do better than average and when are strategic points in the cycle to not over leverage is super important to reducing your risk, increasing your returns, and enjoying your journey as an investor. Now, for those of you listening to this video who love real estate as much as I do, I'd love to offer you a one-on-one strategy session where we can talk about where you are today, where you'd like to be longer term. We can educate you on the Australian property market and the opportunities that still exist between here and here. And then you can take that information with a grain of salt and go and absolutely smash it on your own, or potentially become one of the extremely small number of clients that we take on as buyer's agents each month. Either way, we wish you all the best. I hope this idea has been simple and that you now understand it. I'd highly recommend subscribing to our YouTube channel if you haven't already done so, giving this video a thumbs up and sharing it with someone who has been looking for a pattern and an understanding of global economic cycles that just can't find one.
Woo! That's a wrap.
That's a wrap.
Getting
Have a
cool,
spin.
bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that.
So nice, eh?
Oh.